All right, good afternoon, everyone. Thanks so much for joining us today. My name is Stephanie Creedon, and I'll be your host for today's webinar on regulatory compliance change management. So before we get started, I'd just like to go over a few housekeeping items. Today's presentation is going to be about 50 minutes. We'll have plenty of time for Q&A after the conclusion of the presentation, so please feel free to send in questions throughout the presentation using the Q&A feature at the bottom of your Zoom control panel. Our audience will be muted during the session. And like I said, if you do have questions, just use the control panel to send them in during or after once we get to the Q&A section. So now I'd like to just give a brief background of the firm. Established in 1911, Wolf & Company is entering its second century of providing unparalleled guidance in audit, tax, risk management, and business consulting services. Our multidisciplinary teams are made up of more than 250 professionals, and we reach across 4 offices in Boston and Springfield, Massachusetts, Albany, New York, and Livingston, New Jersey. And we currently employ over 85 risk management professionals in the areas of IT assurance, internal audit, regulatory compliance, and Wolfpack integrated risk management. We provide services to nearly 250 financial institutions in 27 different states and 2 US territories. So it's now my pleasure to introduce today's presenter, Brian Shea, a regulatory compliance senior manager. Brian has been working with financial institutions on compliance matters for over 15 years. So thanks so much for presenting today, Brian, and I'll now hand the presentation over to you to get started.
All right, thank you, Stephanie. Thank you, everybody, for attending this afternoon as I go through change management. So I want to briefly start with a discussion of what the objectives are for today's presentation. So I'm going to be basically providing an overview of the change management processes and controls that we're seeing out there in the financial institution industry. Change management is always an important area. I think especially a year like this year, we've had to really react to unexpected events. Really the focus of my presentation, it's going to look at what are the explicit formal regulatory requirements as it pertains to change management, but also looking at things such as the controls I'm seeing out in the industry and just best practices. So not necessarily everything in this presentation will be regulatory required per se, but there's definitely going to be, I think, some good practices, some good guidelines and controls. And hopefully this is either a confirmation that you're doing things right, or if you're seeing some things in here that you're not doing, some great things to start considering. From a agenda standpoint, I'm going to just briefly start at the beginning, a discussion about why change management is important and really why we're spending the time on it today. After that, I'll really break down into what is officially required, what are really the strict guidelines that we're seeing out there in the laws and regulations, and then jump into controls and best practices. Let's kick it off with why change management is important. So I figure what I'd start us off with is basically giving a sample scenario. This is not something I've officially seen at one in particular institution, but I have seen types of problems like these at some of the institutions I've worked with. So imagine, you're the compliance officer, you're a financial institution, you have an examination going on, and the examiners come into your office and say, hey, you've got a pretty big issue going on. You're offering this rewards checking product, and basically what's happening is you're offering, or you've got these violations or issues that are associated with the product. So in particular, what's happening is we're seeing that maybe some of the interest rate criteria isn't really being met. So, maybe there's like a really great interest rate, 4 or 5%, that's not being met because just the requirements to really get that account aren't being disclosed properly. You're actually charging a higher fee than what's in the disclosure. You've got some advertisements for the products, but they're not really consistent. Examiners have brought in a few different examples to you and have said, hey, look, the terms you're offering in this ad are different than what's in that ad. None of them are really matching up. And the examiners even talked to employees to try to figure out what's going on with this product. And even your employees weren't really sure how it worked. They had to spend a lot of time calling to different people to try to look through written procedures and things like that, and just try to figure out what's going on and how the product works. I mean, the net result of this scenario is that your examiners are citing you for a regulatory violation. They're requiring you to go back and do some reimbursement to your customers, and it's just very unfortunate what's happening. I used an example like that because I think if you kind of were to do an analysis in a scenario like that, you can really drill down and find that change management is a big root cause. So in this scenario, you know, the business line decided to offer a new product, make some changes to the product. The big problem is they never discussed it with the compliance officer. They kind of all did things as much as they could within the business line. Now, somebody was smart enough to realize, all right, I've got to go to my account opening disclosures, I've got to make revisions to it, but timing just wasn't very good. That person got a great opportunity at another institution and left, and nobody really handled the transition well. So the disclosure was amended, but it never went out to the branches. Nobody ended up really using the right disclosure. You know, management did say, all right, let's notify people. Let's tell people how to describe the product, but it was really just done informally through an email. There wasn't really a big update to training material. There wasn't a formal session on it, those types of things. So if you really, drill down into root cause for a scenario like this, it's really all getting back to change management. Really insufficient controls and processes here, and that's ultimately what led to this scenario or sample violation. There isn't really a formal change management definition out there per se. If you were to look at the various laws and regulations, you're not going to see it exactly defined anywhere. But the way I approach it, or the way I think of it, is it's really approaches and processes to prepare, support, and help individuals, teams, and organizations in making change. Do you really have a formal approach, a formal process, ideally, to make sure that when change happens, you're ready for it, not just individually, but also your team and your entire organization. Why is change management important? Hopefully that sample violation scenario was a good example, but here's some really specific reasons to really think about, and why are changes even coming up in the first place. So it's going to happen all the time. I think you could say, all right, well, I'll keep an eye out on the laws and regulations, and whenever those change, I'll be ready for it. But there tends to be a lot more changes that happen that impact your organization beyond just that. So for example, change in management or personnel, maybe a long-time existing employee leaves, people change positions, something like that, where just the people in your organization dealing with things are different than what it was before. Sometimes change is needed because you're not doing things correctly. So maybe you've got an exam violation or an audit finding or something like that requires you to revisit what your processes are and make some key changes. Changes aren't always a bad thing. Sometimes changes could be an opportunity. Maybe there's a situation in your bank where you can make an improvement to an existing process, or maybe become more efficient. And obviously that's going to entail some change as well. A policy change, a strategic change, maybe you've got a change in leadership at your organization, or maybe a change in branding or vision, strategic vision for how your institution operates. And that could cause major policy changes that are going to flow down to management, the business lines, those sort of things. Products and services, a lot of times institutions are offering new products and services, or maybe making major changes to products and services, and obviously that's going to be a big change as well. Systems, vendors, those are really important too. Do you have a vendor or a system relationship that's coming up for expiration? Maybe you're thinking about changing a vendor or a system you're using to, to go to something else that might be better. Or maybe it's just an upgrade to an existing system you're using. All of those are situations that could cause change. There's plenty of risks involved with change. Absolutely situations where you can get in big trouble if you don't get it right. So we want to summarize at least a few of those, negative things that can happen. Obviously, one is just a regulatory violation or audit finding, kind of going back to that scenario I kicked us off with. It could have a negative impact on your examination compliance rating. So if you actually go to that uniform interagency consumer compliance rating system, they actually do include change management as a consideration when setting that rating. So you don't want your examiners to come in and say they have a bad process, because that definitely might negatively impact your rating. It could result in, a reduction in operational efficiency. Maybe things are just not going as smoothly, as quickly, as profitable as they should be. It could absolutely impact communication within your institution. People might not know how to do things correctly. That could obviously, again, lead to issues, violations. It's not just internal. Also think of it externally as well. Improper handling of change management could result in customer confusion, could cause customer service issues, maybe cause a lot more hassle for your frontline staff, your call center, things like that, because customers just aren't understanding things correctly. And that could obviously flow into your reputational risk as well. Improper change management could have a domino effect throughout your organization. So, it could impact the products and services you're offering, the customer experience, the profitability, all sorts of things. So keep in mind that, change management, it's not something in a silo. It's not something that we shouldn't treat that seriously, because it absolutely could have ripple effects throughout the organization if handled well. All right, so again, just a brief overview, kind of covering why change management is important, what are the big risks associated with it. I wanted to kind of discuss some of the formal regulatory requirements that we have involving change management. Most of these changes are product and service based. And if you look in this slide, you'll see that there's, several different laws and regulations that really do provide some specific requirements, processes, things like that for us to follow over change management. And these are typically known as changes in terms. On the deposit side, you've got Electronic Fund Transfers Act, Reg E, Truth in Savings Act, Reg DD, as well as Expedited Funds Availability Act, Reg CC. On the loan side, the changes are principally under the Truth in Lending Act, Reg Z. Also keep in mind, you have eSign. eSign has some change in terms, change management type requirements built into it as well. So in terms of going over the formal requirements that are out there regarding change management and change in terms, I figured I'd take it from a product and service standpoint. So I'll first just provide a description on the deposit side of things. So when you're dealing with deposit changes, really the big thing to keep in mind is that adverse fee changes typically always require some sort of customer notification. This could be a new fee, an increased fee. Maybe you're changing the scenarios under which the fee could be assessed. For example, I have some institutions that might waive, ATM usage at other banks' ATMs, but only up to, let's say, 5 per month. If that institution was going to lower that amount to say 3 per month, that would be an adverse change. That's something that would require customer notification. I think most institutions, I think have a pretty good handle from a fee standpoint, but do keep in mind that there are some other situations that would require notification to customers. Typically, this is adverse changes. So for example, under Reg E, you've got consumer liability for unauthorized transactions. So if you were ever in a scenario where you were increasing the liability to the customer, that would be an example of an adverse change that requires notification. Maybe you're reducing transaction capabilities, stopping certain types of EFT transfers that a customer could do through a type of account. You're probably not going to see this often. I hardly ever see this, but if you're reducing rates on a fixed rate account, that would require notification. I think most situations, if you have any intent of changing rates on a variable rate account, and you don't really have to worry about that, part of the notice. The regulations do provide some timeframes that we are to follow. So it's typically 30 days under Reg DD and Reg CC, and it's 21 days under Reg E. And I'll admit, I'm not really sure why the difference in timeframes. I think it would make most sense if they all just said 30 days, but for whatever reason, under Reg E, it's 21. I will say that most Reg E changes that I see out there are also impacted by Reg DD. So most of the time I see institutions just always following that 30-day clock. But technically, if you do have a change that's only EFT related, you can go with 21 days. Another thing to keep in mind is Reg CC, funds availability, actually requires customer notification even when it's a beneficial change. If you make any change to your availability policy or schedule under that regulation, you need to notify your customers. Hopefully this should be pretty fresh in everybody's minds. Reg CC did just have a recent regulatory change effect on July 1st. In particular, increasing dollar amounts for certain thresholds, such as next day availability, exception holds on large deposits, things like that. So hopefully, each of you who are attending actually did go out and provide notification to your customers for that change because it is required. If you haven't, now's the time to look into it and do it as fast as you can because we're already past 30 days from the change now. On the lending side, I'm breaking a little further. So we do see some form rules pertaining to credit card or non-home secured. So maybe like an overdraft line of credit or a personal line of credit. And there are some separate rules for HELOCs. On the credit card side, it's usually a 45-day notification time window when we have to notify our customers. And that's typically for things like rate increases or other significant changes. So for example, maybe we are adjusting penalty fees or transaction fees. Maybe we're reducing the length of the grace period, situations like that. Reg Z does permit a few situations where you don't have to provide customer notification, but usually that's only if it's beneficial, in most situations anyway. I think there are some scenarios like lowering the credit limit that don't require that advance notice. But if you are in a situation where fees or penalties are imposed, then you would have to make sure you're doing it in advance. Reg Z for, again, on the credit card side primarily, also does permit scenarios where the consumers can actually reject the change. Can't really do this on things like rate changes for variable rate accounts, but there are certain scenarios where the customer can reject the change. And if that's the case, you've got to basically allow them to still pay back the loan and follow certain repayment terms. I'm not going to jump a lot of detail on what those are here, but Reg Z has some nice details for that. On the real estate secured side of things, which again is primarily going to impact you for HELOC products, it's a little easier. So we do see a 15-day advance notification time period to follow. Typically, this is tied into any changes that are impacting that account opening disclosure that the customer would get as part of the loan origination process. Or if you're making any changes to that minimum payment, in particular for increasing it, that's also going to require that advance notice. Similar to the credit card side, there are certain situations where you don't have to notify the customer, in particular if it's something that is benefiting them. So if you're reducing the amount of an annual fee, for example, lowering the interest rate, something like that, you don't have to worry about giving that advance notice. There are some scenarios where institutions may need to basically lock down a credit limit or not permit any further advances to be made. And in that situation, the reg does say that you want to provide notification within 3 business days, including some of the specific reasons for why. I did want to also provide some other considerations. These are kind of things that pretty much could apply across the board to any products or services when there are changes. And again, these all tie back into formal regulatory requirements. First and foremost, notification has to be made in writing. So you can't just telephone people about it. You got to give something in writing. Ideally, you can send something through a statement message, for example, do a mailing. All those types of things are usually acceptable. One thing to keep in mind is, are we actually notifying everybody? So an issue I have sometimes seen some of our clients make as a mistake is sending out a notification, but not realizing that they should have notified passbook customers as well. So let's say, for example, you're sending monthly statements and you put some sort of message on the statements to notify the customers. I think most of my clients are doing something like that. If that change does impact any accounts that don't get statements, you will want to make sure there's some notification to them too. So sometimes I get questions as to, hey, can we just mail out the entire disclosure again? Is it as easy as that? And one thing you have to consider is that the regs say that while that's permissible, you really need to make sure that the customer can tell what the changes are. So simply mailing a complete version of the disclosure booklet without any direction to the customer isn't really sufficient. But if you take some additional action, such as putting things in bold or highlighting them or having a cover letter that describes the changes, something like that usually is acceptable. So I know I already mentioned the statement stuff as messages, so obviously use that. You do have to keep in mind on Reg Z on the loan side that there are some restrictions. I think there's some guidelines in there about like placement of where it goes in the statement and stuff like that. So just keep those into consideration. I think actually most of the time when I see my clients have issues with the statement, it's really more just due to spacing restrictions imposed by the vendor. Sometimes it's character limits and things like that would just make it a little difficult. When you are notifying your customers of the change, also just make sure you let them know what that effective date is as well. Some other things to consider in terms of formal change rules. For the most part, the rules don't really apply to business accounts. So, Reg DD, Truth in Savings, Truth in Lending, EFT, these are all consumer-only regulations. Funds availability does apply to business accounts, but the change in terms rules don't really apply either. So for the most part, when it is a change that impacts a business account, these rules, these notifications, it's really more of a best practice. It's probably a good idea to do something from a customer service standpoint, but you don't really have to officially follow these strict rules that we've laid down here. Some other things to consider: are you using electronic communication? I think more and more institutions are trying to provide email notice or online notice, things that can, reduce the postage costs that are imposed, especially if there's a lot of changes that are happening. So if you're doing that, typically that's fine, but the biggest thing is you have to make sure you're getting that consent under e-sign to deliver those electronic disclosures. So for example, if you're providing the notification through an electronic statement, did those customers that you're sending it to previously consent to receive their electronic statements? So just keep those in mind. If you haven't gotten those consents, unfortunately, you do have to go back and make sure that you're providing paper or written notification, essentially. Another thing to keep in mind from an e-sign perspective, what happens if there's a hardware or software change? That would actually trigger a requirement where you have to get consent all over again. So, let's say you were, originally providing notification to customers through an email, and now you've decided to change that hardware requirement and do it via PDF instead. That's effectively a software change that would invalidate the previous e-sign consent if they weren't consenting for PDF access at that time. So e-sign actually carries a requirement for you to go back and obtain that consent before you essentially continue to send electronic documents. If you haven't gotten that consent, you're going to have to revert back to paper. So just keep that in mind. Obviously, that's a change that could impact your electronic disclosure customers, but also just keep in mind when you're trying to think about your communication methods. If you want to send out a change in terms notification electronically, but you only got e-sign consent in this certain format before, then that really restricts you to sending your change in terms notifications through that particular format, unless you want to go through this whole e-sign consent process for this new method. All right, so those are the formal rules and requirements that we see out there. So it's obviously not all encompassing. Obviously it's really primarily based on customer facing actions, product services, those types of things. But I think it is good that the regs at least do give us some guidance and guidelines to follow pertaining to these types of changes. The rest of the presentation is really going to be focused on change management controls and best practices that I'm seeing out there. So I deal with a wide variety of different financial institutions, gives me opportunities to see a whole bunch of different types of change management controls. I'm going to start off by discussing some big picture controls that I'm seeing out there. Then after that, I'm going to jump into some best practices as well. There are some controls I don't discuss a ton up front just because I focus more on them in the best practices section. So one thing to consider is a risk assessment. And I know we hear risk assessments all the time in our industry, and risk management and compliance. Change management isn't really any different, unfortunately. I would strongly recommend that a risk assessment be a part of the process, and ideally as early as possible in the process. As part of your risk assessment, you want to take certain things into consideration. So for example, all right, we're making a change. Why? Why is the change taking place in the first place? Is it something that is officially required? We've got to do it no matter what, such as it being a regulatory change, or maybe a major systems contract is expiring and we have to change no matter what, they're forcing us to. Is it something like that that's a requirement? Or is it something that's more optional, something that would be good to change, give us some benefits, but we don't have this formal deadline, hanging over our heads. That gives us some flexibility. I think that does impact the risk, as to, do I have to do it, or do I actually have the option to make a decision whether to do it or not? So I think that's really big fundamental part of the process to consider. You want to consider how many people are impacted. Obviously, that's going to impact the risk. I know on the, a lot of times on like a product service standpoint, we're thinking of volume of activity that really impacts the risk. From a change management standpoint, you really want to think personnel. How many personnel within our organization are going to be impacted? Is it just one department? Is it many departments? The more people that are involved, the more people that are impacted, obviously the higher risk that's going to be to us. What's the cost to implement the change? Obviously budgets, revenues, things like that are always going to have to be considered as well. Obviously, with the higher the cost being, probably the higher the risk is. The more consequences we could face if things go wrong. And also think, what's the change going to be from a revenue standpoint and from a profit standpoint? Is this change going to help our institution make more revenue? Is this change going to help increase our profit? You really want to think, is the change worth it? There's unfortunately, going to be situations where we have no choice, in particular regulatory changes, think of the HMDA changes we had a few years ago, or all the TRID changes we had years before that. Sometimes it's just the reg says you got to make this change, you've got no choice, and even if it results in your institution making even less money, unfortunately, sometimes it just has to happen. When you're thinking about those more voluntary changes, things that aren't really directly tied into a regulatory requirement, you're definitely going to want to think about it. At the end of the day, is this change going to benefit our institution? Hopefully it should. If it isn't, we want to ask why we're making the change in the first place. I can say sometimes I've seen institutions say, hey, we're going to make a change in a certain area. They go through the risk assessment, and then they really realize, it's not worth it. We went through all this effort and we realized it's such a major change, and the negative impact is going to have on us is just makes it worth it to not go through with it. And if that is the case, you're going to want to know that sooner rather than later. I would rather know that up front instead of spending all this time, all this effort on making the change and then realizing it wasn't really worth it in the first place. So hopefully, again, that's a really good control to kick things off. I would absolutely recommend that institutions, make this a fundamental part of the process as early as possible. Another thing to consider from a control standpoint, committees or task forces. So have we really designated people in our organization that are going to be responsible and involved in the change process? Now, as with the risk assessment, as with a lot of these other controls I'm talking about, these aren't necessarily set forth by regulation. So you do have a level of flexibility. I would definitely recommend that your institution try to implement some sort of committee or task force pertaining to change. And, it can be dependent on what's your organizational structure. A lot of institutions have compliance committees, and they might say, hey, change management is already a key piece of our compliance committee. So we don't necessarily need a separate compliance or change committee because this existing committee already covers it. But I have absolutely seen other institutions that say, no, we're really taking a different stance. We actually do have a committee that's specifically dedicated just to this change. For example, I have a number of clients that have essentially what's known as like a new product or services committee. So anytime that within the bank they're thinking about a new product or service, this committee is specifically focusing on that, and it's covering all the change management aspects that are going to be tied into that. When you have a committee or a task force, again, you could have maybe a task force, which is like a subcommittee or a group of people within the committee handle it. You really want to make sure that you have proper representation in that group. First and foremost, because obviously this is a compliance presentation, I'd say get your compliance personnel, your risk personnel involved in that discussion, in that process. You'll want to consider what business lines are impacted. So, if it's a deposit product, for example, well, you're going to need the branch is involved. You're going to need operations involved. You may not necessarily need lending involved. But there's going to be other times when it's really going to impact all business lines. Just depending on the nature of the change. Is it more product-based, or maybe it's more something internal that impacts everybody? Anyway, I absolutely say make sure you have proper representation through any of those impacted departments. Compliance first and foremost, but obviously the business lines and really anybody else who's kind of needs to know. You want to make sure that they're involved. Reporting is big. You really want to make sure that senior management is kept up to date on what's going on with these changes. A lot of times it might just involve having a member of senior management within the committee or task force. That way they're deeply involved with the process, know exactly what's going on and can offer their input from a higher level. If that's not the case, then ideally you're doing some sort of reporting to senior management about the change and the process. Keeping them up to date on things. And again, kind of going back to that risk assessment, exercise I discussed. Maybe there's going to be situations where things aren't going smoothly. Senior management needs to know about it. And sometimes that might even impact the decision to make the change in the first place. Accountability is big. If you've got people involved in a committee or task force, make sure that people are being held accountable. One great way to do this is maybe to have more frequent meetings to kind of catch up with everybody and see where they stand. Maybe to assign formal responsibilities and have people check in, that kind of thing. But I think the biggest thing is, make sure people are held accountable. If, you've got 5 different departments involved and one department, gets delayed and doesn't accomplish what they're supposed to, that could cause problems for all the other departments too. Sometimes as a alternative to a committee or task force, I've also seen what are known as change agents or change champions. People are kind of designated people in the organization who kind of act as an ambassador or a champion for when there is change. So, hey, I'm a person in the lending department, and this is one of my major responsibilities. Keep an eye out for change, being the key point person involved when there is change. And so even if there's a committee per se, you've got somebody who's kind of acting in that role or being ready to, put a foot forward basically and participate in that process. Documentation is big. I think this is unfortunately the case with basically any compliance topic we're going to talk about, but obviously as part of the change management process, documentation is a huge aspect. So you really want to think about what are the various documents used within our organization that could be impacted by change. Are they updated appropriately? So, making sure that you're updating your written policies and procedures, so including at a detailed level. I mean, if we are really getting into very specific details, maybe think back to that reward checking example at the beginning. Having detailed instructions about how the product works is a good idea. If it's even something that's not impacting customers at the front line, more office stuff, it's still probably good to have some sort of detailed procedures. You got to remember that people are going to be used to doing things a certain way. And, while, hey, I've been doing this for 10 years, I know how to do it off the top of my head. If you've changed a process, they're not going to know it as well. And it really is a good idea to have something in writing to provide those instructions about what that new process is. What I'll also say is, do you have a change management policy or procedure in the first place? Again, I can't say it's required per se, but it is a great control, a great process to have some sort of policy that's dedicated to change management. If you don't go that far, maybe it's a key element of your compliance policy or a strategic policy or something like that. So that's definitely good practice as well. Make sure you go to your customer-facing disclosures and update them. Kind of obvious, I think goes back to the formal change in terms requirements as I was talking about earlier. You obviously want to make sure that all your customers are understanding any new products or any changed products appropriately. And don't forget to go back and destroy the old stock. I've definitely seen situations where compliance issues and violations have happened because they never got rid of the old disclosures. Some branch that said, oh, I'll save some money, I'll still go with this old one. And months later, after the change, they're still giving out incorrect disclosures. So you absolutely want to avoid that process. I think, the good news, I think a lot of institutions are really moving more and more towards electronic disclosures. Not necessarily that they're always going to the customer electronically, but they're like generated from a system, instead of having a closet or a desk drawer that is filled with a stack of them, and you need to concern yourself as to, hey, do I have the current process, the current version? And I guess that goes into version control as well. Ideally, you just have one master version of the disclosures and documents that you can update. So hopefully you don't have to worry about situations where old versions are still out there and people are following old processes. Definitely not a good thing. Also, back to your training material. Is the training material that you're using reflecting the new processes that you want to move forward with? If you're using an automated vendor, go back, maybe see if there's any ability to do things through maybe like custom slides or edits. I've definitely seen some vendors offer that service where maybe it's, hey, it's still the same regulatory requirements, but some of our actual compliance processes have changed, and let's give some descriptions on that. Also, just for the change management process as a whole, document things as best you can. I think it shows the effort that you've put into it. It shows that you're treating change management seriously. When your examiners come in and are looking into how you're handling change management, wouldn't it be a great idea to be able to give them a folder or a file that says, hey, I can prove to you this situation that happened to our bank that's really showing how good our change management process is. Or what happens if things go wrong. If you've got that documentation, you can ideally go back and through those documents and hopefully give you some advice for where you went wrong, where you have to improve, those types of things. Systems and technology is big too. A lot of times, if anything, this might be one of the biggest impacts when change happens. You really want to make sure you're proactive in communicating with your vendors. I think back to HMDA changes or TRID changes, and a lot of times the biggest struggle my clients had was not what they were doing internally, but rather their vendors, waiting and waiting for their vendors to upgrade documents and forms and systems and things like that. So you really want to get ahead of that as much as you can. Be as proactive as you can with talking to your vendors, getting your systems up to date, especially if it's something that's not tied into a regulatory change. Who knows if your vendors will have the same level of seriousness than if it was a change that's impacting thousands and thousands of institutions that they're dealing with. Sometimes as you go through your change management process, you want to evaluate whether your existing vendors are even sufficient in the first place. Sometimes I have clients that go through the exercise and just realize their existing vendor can't handle what they want to do. So then you have to start taking steps to get a new vendor. I think that ties into contract renewals and things like that as well. Sometimes opportune times for changes are when a major vendor contract is coming up for renewal, since that's really your opportunity to change things. Also be aware of system upgrades and enhancements. Sometimes, unfortunately, we just see that compliance issues or violations happen because of a system upgrade or enhancement. Maybe you had a custom change that was made for whatever reason, maybe due to a past exam or audit finding, and maybe the upgrade overrode it or caused some other issue. So I guess just keep that in mind. Even if your institution itself is not directing the change, if your vendor is passing through some sort of upgrade or enhancement, it's a good idea to look over things just to make sure that there weren't any major changes that impacted you that you weren't expecting. Monitoring and audit. So I think as with anything in compliance, you do want to do some sort of formal evaluations on a periodic basis to make sure that you're still handling things correctly. I think this is especially important when changes happen. My recommendation would be, ideally, if you can set your timeline properly, is to make the change, but also try to evaluate how the change is going before you roll it out to everybody. So like ideally, if it's a situation where it is impacting customers, if you could try to like make the change and then have a monitoring review or evaluation of the results of the change before that actually goes out to the customers, that kind of gives you that opportunity to fix things if something's going wrong before you're actually reaching out. So that's a good practice. It's something I would strongly recommend. You also have to keep in mind that any changes might tie back into your QC process, your monitoring process. A lot of institutions use checklists, QC forms, these kind of things. Well, if you've had a major change to a process or a form or a document or things like that, don't forget to go to these QC checklists, monitoring checklists, and so on to make sure that they're updated. Also, don't forget your audit plan. Especially if it's a major change, you'll want to make sure that you're working with your auditors so they know that the change has happened and that they're prepared to do it within the next time they're auditing that area. If anything, when I'm talking to my clients and establishing audit plans for the new year, this is a question I always like to ask. Have you had any changes recently? But also, are you expecting any changes to happen? If so, let's be ready for it with respect to the audit plan. Those are some of the good controls that I'm seeing out there from a change management standpoint. I also wanted to cover some nice best practices that I'm seeing. So one thing I really like seeing when I'm evaluating institutions and their change management processes is, are they proactive? The more proactive you are, probably the better off you'll be. If you know about a change earlier, you're probably in a better spot to address it. Now, obviously, we've got changes that are directed within our organization, but also changes that are externally influenced, so, and regulatory changes, things like that. What I do recommend my clients do is have some sort of control or process in place to monitor for regulatory change. So maybe this is checking regulatory calendars, checking websites of key regulatory agencies on a periodic basis, signing up for email messages, newsletters, things like that. I know Wolf has a semi-monthly newsletter we issue out there on regulatory changes and just updates. I know American Bankers Association, I think, has a daily update email it sends out. So there's definitely resources out there. And as a compliance person, it's a good idea to kind of get registered, get involved as much as you can to help you identify those changes as soon as possible. I think touches upon something I discussed a little earlier, but also your vendor relationships, your contracts. When are those coming up for renewal? Especially if it's a major contract. One of the biggest changes I tend to see in my clients, and maybe the biggest change I ever see in my clients, is when the core system is up for renewal and the institution decides to go to a new core service provider. I mean, that change could impact almost everything happening within your own institution. So it's a really good idea to make sure that contracts like that, you know exactly when they're coming up for renewal. Because if you don't renew that contract, that is going to be a major change. Sometimes being proactive is good because you don't want to just wait for the change to happen. You kind of want to get ahead of it. And again, this is especially for internal changes. If you think that you could do a process more effectively, more efficiently, make it easier for your staff, why wait? That might be a good opportunity to say, okay, we have a change that we want to formally implement. Let's see if we can do something here. A lot of times that ties into improvements, to enhancements to processes. It doesn't always have to be corrective action to an exam finding or an audit finding or those kind of things. And I think tying into what I was discussing earlier from a risk assessment standpoint, we want to analyze the effect of the change early in the process. The sooner the better. Because sometimes you're going to realize this change is not worth it, and maybe we should not go through all these steps, all the expenses, that kind of thing. Communication is a really big, important best practice to follow as well. I know I've discussed this earlier, but really important thing is just, is the compliance officer involved in the process? And ideally as early as possible. Use the compliance officer. While sometimes you're involved once a new product or service is developed, if you can get involved even earlier in the process, that might help, make the product easier, or just make it better structured. You don't want the business line to spend all this time doing something and then you just to say, no, this violates the law. You can't do this. The earlier that this from the business side of the compliance officer, ideally situations are buying into things, that people are really understanding why we're doing this. You want buy-in from people. So if they don't understand why the change is happening in the first place, they may just not, do it as well as you would hope. So make sure you're communicating the reasonings why, the big picture aspects of the change to any stakeholders involved in the process. Involving all impacted personnel, be careful, make sure you're really thinking about who is involved in the process, who should be communicated with. Is it branch staff? Obviously they're going to be involved in almost anything impacting the customer, but think of some less traditional avenues too. Training. Training probably impacts practically anybody. IT, systems, marketing. There's a lot of areas that could be impacted by the change. So we really just want to make sure we're notifying all impacted personnel. And senior management, again, making sure there's proper communication through the senior management, having them involved in the process, reporting results to them, all critical things to do. Formality. The more formal the change management process is, ideally the easier it's going to be. I know I discussed earlier on that a good control to have is a change management policy. I think that's really helpful if you can define that change management process and what those controls are as best as possible. Because really, think about it. You don't want to reinvent the wheel. If you have a process, a control that's repeatable, that's scalable, you can really use that not just for one change, but many different changes that happen. And again, changes are going to happen all the time. So, don't think that you can really start from scratch every time. Again, think of that committee structure I mentioned earlier. Not necessarily required per se, but it's obviously something that's more formal. And I think institutions do tend to have more success when they formalize it, a committee or something like that, or a task force. Establishing a formal action plan. One thing I haven't really discussed much yet is, are you really plotting out when the change has to be finished, when certain deadlines are, maybe like working backwards, saying, hey, I've got a regulatory change that's effective July 1st. Ideally, I want to be ready a month early so I can at least evaluate it before the effective date. So I want to be ready by June 1st. So what do I do? What do I have to do to make it so I am ready by June 1st? How do I kind of plot out my action plan, my deliverable deadlines, all those sort of things? And the more formal you can be with that, I think the better off your institution will be, and hopefully the easier the process will be for you. And accountability, making sure that people are held accountable for the process. I would recommend that at least one key person in senior management is involved when we're talking about major change management. Sometimes it's even multiple people, but ideally you really want at least one key person because you want to make sure that the organization as a whole is buying into the change, is treating it seriously, and a lot of times that does warrant having senior management involved. You want to evaluate whether the necessary resources are being dedicated to. If you're treating a change is important, but you're not dedicating the appropriate amount of people to it or budget or those kind of things, you may not, be able to effectively make that change the way that you want to. Making sure the responsibilities are clearly defined. I think this does kind of tie back to formality as well. You really want to identify, what the various steps are in the process and which people or departments are really responsible for that. You want to make sure that you are holding members of the team accountable. Are you getting progress reports or, some sort of updates from those people that are responsible for aspects of the process to make sure that things are happening? Again, the last thing you want to do is for, 9 out of 10 departments to be ready, but then that one last department isn't, and that holds up absolutely everything. And again, you also want to analyze the process to make sure that that change is effective and worth it. So I know I discussed earlier monitoring the results of the change, doing this evaluation. Sometimes it's just to say, hey, are we really complying properly the way we're supposed to? But also, again, think of some of those other things I mentioned earlier. We made a change for this reason. It was to correct this issue or to make things easier for our staff, to reduce complaints, to be more profitable. All right, well, can you do an analysis to kind of tie back things into what those objectives were? Are you really getting the results that you were expecting? Hopefully you are. If you're not, something to start revisiting. Do we make the change appropriately? Should we have made the change in the first place? Although, again, ideally, that's something you do as early in the process as possible. All right, wonderful. So again, obviously change management is a big thing. It's a big area, touches so many aspects of the institution. So no way I can cover absolutely everything in 50 minutes. But hopefully this was a good overview, again, of what the key requirements are, as well as what some of those good controls and best practices I'm seeing in the industry.
Thanks, Brian. I just now want to open it to Q&A. So if you have not submitted your question or you have any, please send them in by using the Q&A box at the bottom of your Zoom control panel, and we'll go ahead and start answering some questions. The first question we got is the following. Is it permissible for our organization to post to our website notification of changes to save on postage expenses?
So I think that's an idea I've definitely seen out there from some institutions. I think it ties back into something I was talking about earlier in the presentation about the e-sign process. In that if you're going to notify customers, it has to be in writing. And typically, if it's going to be electronic, you have to get that consent from the customer first. So that's really the big questions you have to ask yourself before you just say, all right, I'm going to post up my changes on the website. Have you gotten that consent, and have you gotten the consent in that format too? You're getting the consent from the customer to make sure they can access your website before you actually post changes on your website, because you got to know that they can actually read it. So if you're doing that, that's fine. But just keep in mind that you do have these written notification requirements. I can say I have some clients that post changes on their website, but it's really rare. That maybe even never. We've seen an institution just said that's the only place we're going to post it, because it's really unlikely that you're going to have 100% of your customer base okaying the electronic communication. There's usually at least some paper people, unless it's literally a product that was developed in the first place to only be electronic. And you have truly no paper people.
Great, thanks, Brian. Next question. Would a change management committee be helpful to our organization? Are you seeing your clients utilize such a committee?
All right, so I think that also kind of ties back into one of the topics I was discussing earlier. So committees is something I'm seeing a lot of at my clients. In particular, I'm seeing compliance committees, so they're not necessarily called or identified as a change management committee. But what I would say is most of the time I'm seeing my clients have a compliance committee, and then change management is one of the key responsibilities of that committee. I think I mentioned this earlier, but I do have some clients that have like what's known as a new product or service committee. They're really saying, hey, anytime we're going to develop a new product or service to offer to our customers, we're going to run it through this committee itself. Instead of going through like a full compliance committee or a full risk management committee or something like that. So That's what I'm most commonly seeing. I don't see a ton of my clients that just have a committee that's solely change management. Usually it's tied into compliance committee or a new product service committee, because obviously that's kind of what's driving, usually what's driving the change in the first place. Either our business line wants a new product or service, or there's new major regulatory compliance changes. So we kind of make it part of those committees. But if you are an institution that's thinking, hey, I want to develop a committee that's really just solely dedicated to change management, I mean, I think that is a great idea. If you're thinking that's not like completely overlapping other committees that are out there, it's definitely good process, good control, good process to have.
Great. Thanks, Brian. It looks like that's all we have received for questions. So just a reminder, if anybody has any outstanding questions, please direct them to Brian's email, which is located in this PowerPoint. The PowerPoint presentation, as well as the recording, will be available at www.wolfandco.com/webinars/2020. And immediately following the conclusion of this webinar, you'll have the opportunity to complete a survey. As always, we appreciate your feedback so that we can continue to improve our webinar program. Thanks so much for attending today, and we hope to see your participation in future webinars. Have a great afternoon, everyone.